Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor. I'm speaking to you here from New York City on the 18th day of July 2017. I do want to remind you that I am the editor, the author of Jay Taylor's Gold, Energy, and Tech Stocks. You can subscribe to that by going to miningstocks.com. And I would encourage you to consider subscribing to my friend Chen Lin's letter, What is Chen Buying, What is Chen Selling? You can do that by going to chenpicks.com. chenpicks.com. And I want to thank you for listening to the show, making it one of the more popular shows in the Voice America Business Channel. Also want to thank our sponsors for making this show economically viable today. Our sponsors are New Range Gold, Klondike Gold, Aron Resources, Novo Resources, Genesis Metals Corp, GMV Minerals Corp, Fireweed Resources, and Osprey Gold Development. I've titled today's show, Using Gold Money to Preserve Your Wealth. James Turk, the founder and lead director of Gold Money, returns this week, as does our most frequent guest, Michael Oliver. He's going to be with me in just moments from now. Cooper Quinn, he's the president and CEO of Osprey Gold Development, visits for the first time to talk about that company's most undervalued gold exploration company. I think it's a very undervalued property in Nova Scotia. You know, America's founders understood that if Americans were to retain their freedom and liberty, an honest asset-backed monetary system must be preserved. Otherwise, money becomes a political instrument in the hands of the bankers and the state to be used to manipulate citizens and markets for the accumulation of power in the hands of a few at the expense of the many. And, of course, this is now happening at an accelerated pace in America. When Nixon detached gold from the dollar, and thus the international monetary system in 1971, the world embarked on a massive indebtedness. Growing global insolvency has been the result, and once you understand how the system works, which is intentionally not taught in our schools, it is easy to see how wealth is being siphoned from the middle class to both Democrat and Republican elites that have taken our country away from we the people. But now, with the Internet, gold is, in fact, reemerging as money. James Turk will explain how you can preserve your wealth with gold and at the same time spend that gold as necessary. And we will learn about Osprey Gold, as I just told you, in a few minutes. I'm going to be talking to Cooper Quinn then. A very exciting project in Nova Scotia, and it is a recommendation in my newsletter as well. Well, last week, Chris Hamilton's views on demographics, economics, and the markets raised a number of comments that indicated that many of you were not completely clear on Chris's theories. Indeed, I told Chris that I was having some trouble getting my head wrapped around his theory about how global population declines, not only, that they would lead to economic decline. That wasn't so difficult to comprehend. Less demand, it makes a certain amount of sense. But what didn't make any sense to me was the idea that the equity markets could rise in perpetuity in this kind of a declining GDP setting. So Chris very kindly responded to my question, and he gave me permission to pass his response along to you today. Here is what Chris said, and I quote, "Regarding your question, all I can say is me too in terms of getting my head wrapped around my own theory. I have made the case that the quantity and quality of organic growth likely peaked in the late 1980s, and since that time, a progression of substitutes and one-time actions have been undertaken. These actions have resulted in an unnaturally high growth rate via the idea that growth could be borrowed from the future, and somehow this would not negatively impact future growth rates. The huge problem is that the present and future are nothing like the past 70 years when these really bad assumptions seem plausible. Well, they seem plausible, I might add, to some people, not to Austrian economists for sure. But central bankers, Chris goes on, he says, central bankers and federal governments have used a wide variety of knobs and dials which have significant impacts on financial markets, but far less on economies and perhaps zero or negative impact on population growth, which he says is the most important factor in economic growth. Well, that is a debatable point, no doubt, but he certainly shows some correlation with population declines and rate of population growth declines and economic well-being. There could be other factors, but this is Chris's thesis. I go on with Chris, continues, he says, so bad assumptions and entirely mistaken theories projecting that thousands of years' worth of trends would continue into the future have proven entirely disastrous. A check of the under 65-year-old populations of the OECD China, Russia, Brazil, and nearly all nations outside of Central Africa show a massive depopulation is underway from the bottom up, but is presently masked by the impact of the elderly living decades longer, leading to a one-time off appearance of population growth. Simply put, the past and present was predicated on a future that will never come to pass. They extrapolated and banked on past growth trends to continue and even accelerate into the future. How wrong they were. My opinion that the markets will continue to rise is based on necessity. The market must rise or the financial, economic, and perhaps even the social systems are in peril. So I am attempting to solve an equation where the free market constants are negative and the variable is human nature. The odds are that as things get worse economically, due to population demographics, debt, resources, dilution, depletion, etc., new and stranger dials and knobs will be needed to and turned even more violently. I have shown the largest of the markets are no longer functioning in a manner to freely determine prices between buyers and sellers, and thus these markets are now likely every bit as farcical as North Korean propaganda, but generally accepted by the public due to the lack of credible alternatives. He goes on, and I just want to wrap it up here, but he said, I believe that we crossed the fail-safe point some time ago, and thus there is no turning back or allowing a natural correction. The most likely model is the Japanese bond market, in which volume is nearing zero and goes entirely days absent a trade. A steady grind higher for equities prices and lower bond yields, both on a continually declining volume, is already clearly visible. The idea seems burn what fuel is left, in the hope that critical mass of technology or innovation or some combination of all these and more might allow some sort of quantum leap from our present state of something else. Of course, this is not a plan, but simply a silly notion. Unfortunately, anyone promoting a concrete plan will be roundly shouted down. So silly notions and rising markets are what I expect. And yes, when it falls, and I can't imagine how this travesty won't, my best guess is precious metals will have real value on the other side. But unfortunately, even here there are no guarantees, just probabilities. End of quote. Well, that is the end, as I say, of Chris's remarks, but I might add a caveat to what Chris said. There are no guarantees within the four dimensions of time and space, but there are possibly in some other dimensions. But that's a topic for another day. We do want to keep our feet firmly planted on the ground and in these four dimensions, and so to help us do that, Michael Oliver is with me once again. Thanks for joining me today, Michael.
Hi, Jay. Good to be back.
Good to be back. Well, you heard a very sort of dismal viewpoint there from our guest last week. With respect to gold, there's been a lot of people wringing their hands over gold. A lot of the bulls are really sort of have been beside themselves. But all along you said, well, maybe if it went to 1997, the gold price, to 1197, you might have to turn neutral. But it didn't go there. It seems to be heading the other way. What are your latest thoughts on gold? Are we out of the woods now, Michael?
I think you're probably out of the woods. There's a number this week I wanted to get above, and I'd like to close the week out above. It's 1229. We did that yesterday, and now we're at 1243. There's a number overhead on the GDX, the gold miner ETF, and on gold that is literally one good day away. And if I can close a week out, you can close gold out at a week out at, in the low 1260s, call it 1262, okay? If you do that, I've got some quarterly momentum oscillators, which is a long-term oscillator, that will post its highest weekly close in the last several quarters. It's in part because the three-quarter average has been declining, and price is moving up toward it. Anyway, that's a very positive-looking momentum structural number for me. So literally, today's high is 1244, so I'm saying less than $20 above today's high is a very good-looking weekly close to occur anytime this quarter. It have to occur this week, anytime.
Okay.
GDX is now 2220, I think, somewhere about 2260. I would get very excited about GDX launching, coming out of this coiling action it's had for quite some time. Just like gold has had big coiling action for quite some time. Whereas you made your bear market low, you had your huge move off of that low in both those markets. And then you came down hard, did not make a new low, went back up hard, came back down, and it was your coiling. And this is a market that's twisting and turning, ready for its next leg, and I think that next leg is not far away. Mm-hmm. The main thing we've been focused on this year coming into the year was the dollar index, which had been sedate for 2 years at high levels, very sedate, almost asleep in a very narrow range. And we came into the year trading 101. We said if you broke 99, it's a bear market. There have been quite a few cries by technicians in the last several months since it broke 99 for a big rally. And it just doesn't seem to happen. Right now we're trading in the 94s. I suspect the dollar index is going to 88 as a first major landing point. And from that point, you might actually get a counter-trend rally of some nature. But that's still a long way below here, and I think gold will be a lot higher than it is now when the dollar gets to 88, the dollar index. By the way, the attack on the dollar now is almost across the board. It had been very selective last year. But now it's the euro, the yen is even firming through some numbers that I think are important. The British pound is firming. Canadian dollar is rock solid. We'd anticipated that several months ago. So it's an across-the-board assault on the dollar. And I think that will have ramifications on the debt markets as well, and ultimately then on the, shall we call it, the less intelligent markets, the equity markets, which tend to sort of, have to get hit in the head with a bat before they realize reality. I suspect on the stock side, which is no doubt frustrating to many people who are fundamentally negative on the stock market, its ability to hang in here. It's really not exploding. If you look at a chart, we're all of 0.5% higher than we were 2 months ago, 3 months ago, whatever. And literally less than 2% below where you are right now, the S&P cannot go. If it goes there, as far as we're concerned, it's over. You've seen your high. You're headed down, probably in an irregular manner, not in an easy manner. It's not going to be an easy short, I don't think, this year in the stock market. This is not 87, it's not 29. This is it's more. If you recall, 2008, the bear market there, when it came out to shoot early in January, February of 2008 on the downside, dropped a couple hundred points. And then spent all the way from the March low through the May high, coming all the way back up to unchanged on the year, effectively. Totally fooling people. It wasn't until late in the year of 2008, after the major damage had already occurred, technically speaking, that they finally unleashed on the downside. And I suspect we're looking at something like that in the equity markets this year. Is you make a top, but you really don't get paid for it yet.
Yeah. Well, it's certainly a lot of vested interest in the halls of Congress. Most of those guys and girls own shares of stock, and they're very close to Janet Yellen. As soon as the stock market starts to throw, as David Stockman calls it, a hissy fit, out comes some kinder, gentler words for the for the interest rates, and up we go again. But at some point in time, I guess Mother Nature will prevail, right, Michael?
I think it's exactly right. And on the Japanese market, for example, which has got to be the most frustrating bond market in the world, in that I think the investing public has given up on the idea that it will ever go down, that rates will ever rise, because the central bank there, the BOJ, is just in charge. And I doubt that. I think all they've done is create an exacerbated situation that when it does come undone, is likely to come undone more so than the other markets.
Right. Ultimately, you and I have been around long enough, Michael, to know that Mother Nature does prevail, ultimately. So we'll have to leave it go at that. We're out of time. Great. Thank you so much again, Michael, for your updates on this. Very, very reassuring. Certainly bullish for gold, I would gather, going forward now. So thank you very much.